Tasmania. It's not exactly the first state that comes to mind when most investors think about property. It's small. Population growth has been sluggish. And while Perth, Brisbane, and Adelaide have been delivering double-digit returns for 3 years straight, Hobart has been quietly sitting on the sidelines. But something has shifted. In the last few months, investor activity in Northern Tasmania has surged 56%. The state just approved a $1.13 billion AFL stadium that will transform Hobart's waterfront. There's over $30 billion worth of infrastructure projects in the pipeline, and rental vacancy rates are rising across the state and sitting at some of the tightest levels in the entire country. Today, I'm going to break down what's actually happening in Tasmania's property market, why it might be one of the most overlooked opportunities in Australia right now, and the specific pockets that are worth your attention. Let's start with the honest picture, because I'm not just here to hype a market. Tasmania's property performance over the past couple of years has been underwhelming compared to the rest of the country. Hobart's annual dwelling growth, which is running at about 7% now, is a solid recovery from the 12.7% annual decline recorded in mid-2023. But it still trails behind Perth, Brisbane, Adelaide, and even Darwin. The reasons are well documented. Tasmania has the slowest population growth of any Australian state, just 0.2% in the last year, compared to 1.6% nationally. Net interstate migration has actually been negative, meaning more people have been leaving Tasmania than arriving from other states. And the economy has headwinds. Relatively low labour force population, slower jobs growth than the national average, and state government debt. So why am I even talking about it? Because property investing isn't about buying what's already boomed. It's about buying what's about to turn. And Tasmania has 3 specific catalysts converging right now that I think most investors are completely ignoring. The first one, in December 2025, Tasmania's upper house voted 9-5 to approve the Macquarie Point Stadium, a $1.13 billion, 23,000 seat domed stadium right on Hobart's waterfront, next to the CBD. This is not just a stadium. It's the single biggest property catalyst Tasmania has seen in decades. Let me explain why this matters for investors. Firstly, the stadium is a condition of the AFL granting Tasmania its own team, the Tasmanian Devils. They'll enter the AFL in 2028 with the stadium targeted for completion by 2029. Having an AFL team transform a city's identity and national profile. Think about what the Gold Coast Suns did for that region, or how Greater Western Sydney Giants raised the profile of Western Sydney suburbs. Second, the stadium is the anchor for a massive urban renewal precinct at Macquarie Point. We're talking retail, arts, hospitality, residential, and entertainment. The federal government is putting in $240 million for the broader precinct. It includes a new 1,500 delegate conference facility that Hobart currently doesn't even have, which will directly boost visitor economy and bring corporate events to the city. Third, and this is the part that's most relevant for property investors, construction is going to pump serious economic stimulus into a small economy. We're talking 1,500 to 3,000 jobs during the construction phase and around 280 ongoing roles once operational. In a state with a population of about 570,000 people, that's a material impact on local employment and spending. Now, I want to be balanced here. The stadium has been controversial. The Tasmanian Planning Commission actually recommended against it, citing concerns about economic viability and the impact on the waterfront. The cost has blown out from an original estimate of $715 million. There are legitimate questions about whether a state of Tasmania's size can support a project this large. But the political decision has been made. Construction is happening. And from a property investment perspective, what matters is the flow-on effect, the jobs, the infrastructure, the national attention, and the urban renewal. That's all real, regardless of whether or not you thought the stadium was a good idea. The stadium is just one piece. Tasmania's total infrastructure pipeline over the next decade is estimated at a staggering $30 billion. Let me walk you through the key projects. Firstly, the Bridgewater Bridge. This is Tasmania's biggest ever transport infrastructure project at $786 million. I've driven on it. It opened in mid-2025, replacing a narrow, aging bridge that was a massive bottleneck between Hobart's northern suburbs and the CBD. We now have a 4-lane bridge connecting the Brooker Highway to the Midland Highway, and it's already improving commute times to suburbs like Bridgewater, Brighton, and Gagebrook. These are some of Hobart's most affordable suburbs, and the improved accessibility is a direct catalyst for demand. The Tasman Bridge upgrade, $130 million to strengthen and upgrade safety barriers and pathways on Hobart's most critical bridge, which carries 70,000 vehicles per day. Construction starts in 2026. The Marinus Link. This is a proposed undersea electricity cable connecting Tasmania to the mainland. The first stage alone is estimated at $3.8 billion, with full transmission upgrades potentially reaching $6.5 billion. Whether or not this goes ahead in its current form, the energy sector is driving billions in investment into Tasmania, including the Robbins Island wind farm and other renewal projects. These projects bring construction workers, engineers, operational ongoing staff into regional areas. And then there's the Northern Cities Major Development Initiative, which is aimed at revitalizing Launceston, Devonport, and Burnie, the Derwent Entertainment Centre upgrade, the Treasury Complex redevelopment on Hobart's waterfront, and a new 105 AFL high-performance centre in Kingston. The point is this: Tasmania is punching way above its weight in infrastructure spend relative to its population. And infrastructure spend, ladies and gentlemen, is one of the most reliable predictors of property market performance. Every one of these projects brings jobs, improves amenity, and increases the appeal of living in Tasmania. Now, for the last catalyst, and this is the one that cash flow focused investors need to hear. Ladies and gentlemen, Hobart's rental vacancy rate sits at just 0.6%, making it Australia's second tightest capital city rental market. Launceston is even tighter at around 0.5%. These are levels that signal severe undersupply. Rental yields across the state are strong. Launceston houses are returning around 4.7%, well above the average of Australia's major populated cities. And that yield has actually been improving because rents have been growing faster than sale prices. In some regional areas like Burnie and Rosebery, yields are pushing towards 6.5% and above, which is extraordinary. Total listings in Tasmania have dropped 21% year on year. There simply isn't enough stock to meet demand. Building approvals are rising slightly, up about 10% year on year in late 2025, but construction rates are still well below what's needed. The undersupply is structural, not cyclical. Westpac's head of macro forecasting noted that purchasing intentions in Tasmania surged nearly 40% year on year, the largest increase of any state. So you've got rising buyer intent crashing into declining supply. That's a recipe for price pressure. So if you're persuaded by the macro story, where specifically should you be looking? Let me break it down by area. Firstly, the northern suburbs. The northern suburbs of Hobart, Glenorchy, Moona, Bridgewater, Berrydale, Chigwell, Claremont, those are where I'd start. These suburbs benefit directly from the Bridgewater Bridge completion, which has cut commute times in both directions significantly. They're also the most affordable suburbs in the greater Hobart area, which means they're accessible to investors and first home buyers. Bridgewater itself is particularly interesting as a very affordable market that has now dramatically improved connectivity. The analysts from Domain specifically flagged the northern suburbs as likely to attract stronger growth and investment than other parts of Hobart in 2026. There is a large risk tolerance needed to invest in Bridgewater, but also large upside here at play if all the cards line up well. For growth-focused investors with a slightly higher budget, Hobart's inner city unit and townhouse market has been a standout. The CBD unit market has recorded exceptional growth recently, driven by demand from professionals and the short stay accommodation market near Salamanca Place and the waterfront. West Hobart and the CBD fringe are also worth watching. The Macquarie Point precinct redevelopment is expected to reshape demand in nearby suburbs over the next decade. If you can get in before the construction noise settles and the urban renewal precinct takes shape, these areas could see meaningful uplift. Launceston, ladies and gentlemen, is where the yield story really shines. Vacancy rates of 0.5%, rental yields at 4.7%, and median house prices still sitting around $570,000 to $590,000. That's an entry point that's accessible to most investors, and it throws off genuine cash flow from day one. Suburbs like Ravenswood are offering median house prices around $385,000 with yields pushing close to 6%. These aren't glamorous suburbs, but for investors who want positive cash flow and a long-term hold, the numbers work. The Northern Cities Initiative is also bringing government investment into Launceston's revitalisation, which should support demand over time. One important note on Launceston, population growth has actually been slightly negative recently, with the city losing residents to other states. That's a risk you need to price in. The investment case here is about yield and infrastructure-driven improvement, not about explosive population-driven demand. Be eyes wide open on that. For the most aggressive yield chasers, and I know there's a few of you guys on this channel, the Northwest Coast, Burnie and Devonport is where you'll find some of the highest rental returns in Australia. Yields of 7 to 10% are possible in some pockets. These areas benefit from the energy sector, investment in agricultural industry, and the Northern Cities Development Initiative. But let me be upfront, these are high yield, lower growth markets. Capital appreciation is likely to be modest. You're buying for cash flow, not for a doubling of your property value. Make sure that fits your strategy. Ladies and gentlemen, I wouldn't be doing my job if I didn't cover some risks, and Tasmania has some genuine ones. Population growth is the biggest concern. Tasmania is growing at 0.2% per year compared to 1.6% nationally. Net interstate migration is negative. If that trend continues or worsens, it puts a ceiling on demand. Infrastructure investment can help, but it can't fully compensate for people leaving the state. The economy is narrow. Tasmania is heavily reliant on government, tourism, and agriculture. It doesn't have the diversified economy of Melbourne or Sydney. A downturn in any of those sectors has an outsized impact. Interest rate sensitivity is real. Hobart is still 5.1% below its previous peak. If rates rise further, which is a genuine possibility given sticky inflation, buyer demand could soften quickly in a market that's already price sensitive. And the stadium, well, it's a double-edged sword. Yes, it brings in investment, but it also adds over $1 billion to state government debt in a state that already has relatively high debt levels. If the economics don't work out, it could become a drag rather than a driver. The honest assessment is this: Tasmania is a higher risk, higher reward play compared to something like Melbourne or Sydney. The fundamentals are improving, the catalysts are real, but the margin for error is thinner. This is a market for investors who do their homework, not ones who buy blindly in. So let me bring it all together. Tasmania's property market is in the early stages of a comeback, driven by three converging catalysts. Number one, the $1.13 billion Macquarie Point Stadium and AFL team transforming Hobart's identity. Number two, a $30 billion plus infrastructure pipeline that's disproportionately large for a state of this size. And number three, a rental market that's among the tightest in the country with vacancy rates below 1%. The specific pockets I'd be researching for are Hobart's northern suburbs for affordable entry with the Bridgewater Bridge upside, Launceston for strong cash flow yields, and the CBD fringe for longer-term capital growth tied to the Macquarie Point precinct. The Northwest Coast is there for aggressive yield seekers who understand the trade-offs. PropTrack expects Tasmanian property prices to reach new record highs in 2026. Depending on who you ask, the growth will be moderate. We're talking 2 to 6%, maybe not the 10 to 15% you've seen in Perth. But in a market where entry prices are still well below mainland capitals and yields are strong, steady growth can deliver genuine returns. If you're interested in more state-by-state analysis like this, make sure you hit subscribe. I've been covering markets that most property YouTubers completely ignore. Launceston, Hobart, regional pockets, because that's where the real opportunities are for investors who are willing to look beyond the headlines. Drop a comment below if you've invested in Tasmania or if you're considering it. I'd love to see what you're seeing on the ground. See you in the next one.